In Module 3, we're going to be looking at the current asset section of the balance sheet. So you may want to look at the AmeriSource-Bergen statement and follow along with me to refresh what these current assets look like on that particular statement. The topics we're going to cover is what is a current asset, and then what are the types of current assets, and we'll discuss them individually: cash, short-term investments, accounts receivable, inventory, prepaid expenses, and then we'll discuss some ratios that we use to analyze the various current assets as far as their content is concerned. A current asset, by definition, is an asset that will convert to cash during the accounting cycle. So normally that means that something is going to convert to cash during the next fiscal year. When we look at cash, we're going to talk about cash in bank, petty cash, lock boxes, and bank reconciliations. Cash in bank is the cash that's in the checking account available to a business organization to use in their operations. And it's normally like you would think of cash in a bank. It would be something that's available for you to write checks against and to make deposits against. Petty cash, on the other hand, is an impressed account. It normally is a small amount of money, about $500, and is maintained by a custodian, quite often the office manager, and this money is available to be used for small expenditures without writing a check or issuing a purchase order. So at any one time, if you were to examine this petty cash box, it should have cash plus receipts in there equaling the impressed balance. So it may have $350 in cash and $150 in receipts. At some time when the amount of cash in the box reaches a small amount, the cashier will ask for reimbursement to bring the box back up to $500 in cash, and this rolls over and over and over. Petty cash boxes have pretty much been replaced in recent times by procurement cards, known as P-cards. So rather than having the cash available, there is a credit card that's available that can be used to make small purchases, and then the credit card is then turned in to be paid by the accounting function, and the individual managing the procurement card is responsible for making sure that the items purchased on it are correct and specific. For example, you can't use it for personal purchases, and some companies limit the procurement card to certain types of items. At the end of each month, someone should reconcile the bank cash in bank. And this should be done promptly upon receiving the bank statement to make sure there are no errors that have occurred on the part of the bank or the company. And if there are, they can be rectified as soon as possible. The bank reconciliation should be reviewed by someone other than the preparer. And I strongly recommend that in a small business that the owner of the business themselves review the bank reconciliation. From my experience, most of the defalcations that occur in small businesses occur in the stealing or misuse of cash. And quite often the owner is not aware of the situation until somewhere down the line it is discovered, or the company just simply runs out of cash, and then they have to try to figure out why they don't have any cash in the bank. So the bank reconciliation should be done at the end of each month, and it should be reviewed by someone other than the preparer. This is an example of a bank reconciliation. We start out with the balance per bank statement. We had deposits in transit of $5,000. Deposits in transit are funds that have not yet been recorded by the bank. There might have been a day's delay in getting them recorded, but they've been accounted for in the books, but they have not been reflected on the bank's records. And then, of course, you always have outstanding checks that have been written by the organization but not yet presented to the bank for payment. And in addition, quite often there are bank fees that have been charged to the account that have not been recorded in the books. So in this case, we have deposits in transit of $5,000, which we have to add back. Then we subtract $12,000 in outstanding checks, and we deduct and record the $50 of bank fees. So our balance per books should now be $44,050. Then when we look at the bank statement itself and go through and adjust it for those items, we start with the bank statement of $51,000. We have the deposits in transit and deduct the outstanding checks. So our correct bank balance is $44,000. We then do the same thing to reconcile our books to the bank statement. We start with the $44,050 that we show as a cash balance on our books. We subtract the $50 of unrecorded bank charges. So now our adjusted balance per books is $44,000. So we have now reconciled the balance between the bank account per the bank and the bank account per our books. This is an extremely important control function in the organization. I've seen many organizations, particularly small ones, that do not reconcile their bank statement on a timely basis, and this only leads to some very difficult times farther down the line when the errors are discovered. When you're talking about cash, we also need to talk about lock boxes. Lock boxes are basically a post office box at a remote location. And lock boxes are used to speed up collection of funds from customers. These are particularly used by large corporations that have offices around the United States, and they have customer concentrations. So, for example, if you had a concentration of customers in the Seattle area, you might set up a lock box or at a post office box in the Seattle area and instruct your customers in that particular area to mail their checks to that post office box in Seattle. You then would have an account with a bank, and they would go to the post office box, known as the lock box, and they would pick up the checks and then deposit them into the company's account. So this would speed up the deposits reaching the bank account by 2 or 3 days, rather than perhaps mailing them all to Boise, Idaho. So you'd have a lot larger lag in the days of collection. These are widely used by larger corporations to actually speed up the collection of cash. We also have what we call short-term investments. Quite often these are marketable securities. From time to time, an organization may have excess cash that they do not need, but at the same time they don't want to invest it in some asset or that will be not available to them on a fairly ready basis. But they do want to earn interest on it. So they would go ahead and buy short-term investments, sometimes short-term certificates of deposit or short-term treasury notes that can be converted to cash very quickly, but also earn them interest on their account in the meantime. Sweep accounts have, to some extent, replaced the purchase of marketable securities. What a sweep account is it allows the company to keep their funds vested in the banks for interest and then drawn down on as they're needed. It's a very transparent and efficient way to manage your cash. So what happens is you have your cash invested in a bank for interest. The checks are presented to the bank. The bank then sweeps the checks and pulls down enough of the funds out of the invested money to pay for the checks. And at the same time, if you have more money deposited during the day than you need to pay the checks, they will sweep the excess funds back into the investment account so it can earn interest. These are widely used by larger companies, and it's a very good way to manage your short-term cash. So basically, at midnight on any single day, there would be no cash balance in the checking account. It would be all either reinvested in the investment portion of the bank. A second type of current asset is an account receivable. This represents monies owed to the company by customers who have bought merchandise or to whom they have provided services. On the balance sheet, the accounts receivable are normally reflected at amounts the company expects to collect after allowing for a percentage of bad debts. Accounts receivable can normally tie up a very large amount of the working capital of a company, and so they require a high level of attention from management. If you don't keep on the collection of your accounts, then your chance of having to write off more of the accounts becomes larger, and you're outside the cash. You need to collect the cash as soon as you possibly can within the terms that you have with the customer. One of the things we do this is using accounts receivable aging. In other words, you'll notice that there are customers listed down the left-hand side of the particular schedule. Then we have columns across representing when the accounts were due. Current, 30 to 60 days, 60 to 90, over 90 for a total. And then you age these out. So company Able had $150 due that's currently collectible, and they had $25 that was past due for 30 to 60 days. Best Buy has $300 that are past due in the 60 to 90 day column. Charlie and Delta are current on their receivables, and Epsilon has an account that's over 90 days past due. When an account gets out that far, there's something wrong. Either the invoice was incorrect that was sent to the customer, or the customer is lagging for not paying it for some reason or another. The accounts receivable aging is used by the collection personnel in monitoring the accounts receivable and trying to keep them as current as possible. There are 3 ways of estimating your bad debts. The first is using a direct write-off method. This means that you do not set up a reserve against the accounts receivable, but you write the account off when it becomes past due, or you can no longer collect it. Another method is a percentage of sales based on past history. In this particular instance, a business knows that 1% or 2% of their sales are always not collectible. So at the end of the accounting period, they set up a reserve of approximately 1 to 2% and charge it to bad debts, and then set up a contra account against the accounts receivable to reduce the book amount shown by the net of that amount. And then some people use the accounts receivable aging to estimate possible losses. So once an account reaches, let's say, 90 days, they may say, well, we have a 100% probability of not collecting that account, or we have a 50% probability of not collecting that account, and so then they go ahead and write that off using the direct write-off method. We have some management tools we also use in addition in monitoring our accounts receivable. And 2 of them are called the quick ratio, sometimes called the acid test ratio, and another is called the days outstanding in accounts receivable. And I want to show you how to calculate these ratios. Let's assume that we have current liabilities of $450,000. We have current assets representing our cash, short-term investments, and accounts receivable equal to $500,000. Now, in calculating the quick ratio, we only use cash, short-term investments, and accounts receivable. We do not use the remainder of the current asset accounts. And the average accounts receivable are $300,000. Our sales for the last year were $1,100,000. So now let's make a calculation. To calculate the quick ratio, we divide the cash plus the marketable securities plus the accounts receivable by the current liabilities, and we get a ratio of 1.1. So this means we have more than $1 in quick assets to cover every dollar of current liabilities. This is a very good ratio. 1-to-1 ratio for our quick ratio is very, very good. It means that we're very liquid and can certainly meet our current obligations when they come due. Now let's talk about some other accounts receivable ratios. One is called the accounts receivable turnover ratio, and the other is the age of receivables. Using the same information that we had previously, we will now make these calculations. To get the turnover ratio, this tells us how many times we turn over our accounts receivable during a year relative to sales. So our sales were $1,100,000. Our average accounts receivable were $300,000. So we turn them over 3.67 times. This appears to be a little high, which means that on the average, we turn our accounts receivable over about every 50 days or so. This quite often, companies like to have this at least as fast as 4 times or maybe even 5 times a year. Again, that will be governed by the type of business you're in and what your competition does. Here, to get the average days outstanding, we take the 360 days divided by the turnover ratio, which comes out to 98 days. And again, as I say, this looks very high. Most companies would want this to be in the neighborhood of 45 days to 50 days. In using these ratios, we would compare these to other industry averages to see how we stack up against our competitors. We should be collecting our accounts as fast as our competitors do. If not, it means that we have a fault in the way we're managing our cash and our working capital.